The internal audit function is an independent and objective assurance and consulting activity that adds value by improving an organization's governance, risk management, and internal control processes. Unlike external audit, which focuses primarily on expressing an opinion on the financial statements, internal audit adopts a broader organizational perspective by evaluating operational efficiency, regulatory compliance, information systems, fraud prevention, and strategic risk management. The function supports the Board of Directors and Audit Committee by providing independent assessments of whether internal controls operate effectively and organizational objectives are achieved efficiently and ethically. Modern internal auditing has evolved from a traditional compliance-based role into a strategic governance function that contributes directly to organizational performance, accountability, and long-term sustainability. The scope of internal audit extends across virtually every aspect of an organization's activities. Internal auditors evaluate financial controls, operational processes, risk management systems, corporate governance arrangements, compliance with laws and regulations, information technology controls, environmental and sustainability practices, cybersecurity, business continuity planning, and organizational performance measurement. Through risk-based audit planning, internal auditors identify areas of greatest strategic and operational significance and provide recommendations that improve efficiency, strengthen controls, reduce business risk, and enhance decision-making. Because internal audit operates continuously throughout the year rather than periodically, it provides management with ongoing assurance regarding the effectiveness of governance processes and internal controls while supporting continuous organizational improvement. Despite its broad scope, the internal audit function possesses several inherent limitations. Internal auditors remain employees or service providers engaged by the organization and therefore may face perceived threats to independence or objectivity, particularly where reporting relationships are not sufficiently independent of operational management. Their recommendations are advisory in nature and cannot compel management to implement corrective actions. Resource limitations, restricted access to specialist expertise, inadequate staffing, or insufficient technological capability may reduce audit coverage and effectiveness. Furthermore, internal audit cannot eliminate fraud or guarantee organizational success because management override, collusion, human error, and changing business conditions may undermine even well-designed control systems. Consequently, internal audit provides reasonable rather than absolute assurance regarding governance and control effectiveness. Many organizations choose to outsource the internal audit function to external professional firms rather than maintain an in-house department. Outsourcing involves engaging an independent specialist organization to perform internal audit activities under the oversight of management and the audit committee. The principal advantages include access to highly qualified specialists, industry expertise, advanced audit technology, greater flexibility in resource allocation, reduced recruitment and training costs, and improved independence from operational management. External providers often possess specialized knowledge in areas such as cybersecurity, forensic investigations, regulatory compliance, environmental auditing, and information systems that may not exist internally. Outsourcing can therefore improve audit quality while allowing management to concentrate on core business activities. However, outsourcing also presents significant disadvantages. External providers may possess limited knowledge of the organization's culture, operational processes, and strategic objectives compared with permanent internal staff. Confidential information may be exposed to third parties, increasing security and confidentiality risks. Long-term outsourcing arrangements may reduce organizational learning and weaken management's ownership of internal control systems. In addition, excessive reliance on external providers may create dependency and reduce flexibility when responding rapidly to emerging operational risks. Organizations should therefore carefully assess cost, expertise, confidentiality, independence, and strategic requirements before deciding whether to outsource internal audit activities or maintain an in-house function. Internal audit assignments encompass a wide variety of assurance and consulting engagements designed to improve organizational effectiveness. Value-for-money audits evaluate whether resources are acquired economically, utilized efficiently, and converted into effective organizational outcomes, emphasizing economy, efficiency, and effectiveness. Information technology audits assess cybersecurity, access controls, data integrity, disaster recovery procedures, and system reliability within increasingly digital business environments. Financial audits evaluate accounting controls and financial reporting processes, while regulatory compliance audits assess adherence to legislation, industry regulations, taxation requirements, environmental obligations, and corporate governance codes. Fraud investigations involve examining suspected fraudulent activities, identifying control weaknesses, preserving evidence, and recommending improvements to prevent recurrence. Customer experience audits evaluate service quality, complaint handling, customer satisfaction processes, and operational practices that influence organizational reputation and stakeholder relationships. Operational internal audit assignments focus specifically on evaluating the effectiveness and efficiency of business operations rather than financial reporting alone. Such assignments examine production processes, procurement systems, inventory management, logistics, human resource practices, project management, marketing activities, and service delivery to determine whether resources are utilized effectively and organizational objectives are achieved economically. Operational audits identify inefficiencies, waste, duplication of effort, bottlenecks, weak performance measurement systems, and opportunities for process improvement. Recommendations arising from operational audits frequently support cost reduction, productivity improvement, enhanced resource utilization, improved customer service, and stronger strategic execution. Consequently, operational auditing represents an important value-adding function that extends well beyond traditional financial assurance. The results of internal audit engagements are communicated through structured internal audit review reports addressed to management and those charged with governance. A well-prepared report typically includes the audit objectives, scope of work, methodology applied, summary of findings, detailed observations, risk implications, root causes of identified weaknesses, conclusions, and practical recommendations for improvement. Findings should be prioritized according to risk significance and supported by sufficient evidence obtained during the engagement. Management responses and agreed implementation deadlines are frequently incorporated into the report to facilitate accountability and subsequent follow-up procedures. Reports should remain clear, objective, balanced, and constructive while emphasizing opportunities for strengthening governance and operational performance. Effective recommendations are a distinguishing feature of high-quality internal audit reporting. Recommendations should address the underlying causes of identified weaknesses rather than merely their symptoms and should be realistic, cost-effective, and aligned with organizational objectives. Examples include strengthening segregation of duties, enhancing authorization procedures, implementing automated controls, improving cybersecurity measures, revising policies and procedures, increasing management monitoring, introducing staff training programs, or enhancing risk management frameworks. Follow-up reviews should subsequently evaluate whether agreed recommendations have been implemented successfully and whether they have achieved the intended improvements. Through comprehensive audit assignments and effective reporting, the internal audit function supports continuous organizational improvement, strengthens governance and risk management, and contributes significantly to long-term organizational success.